Oklahoma spends about $1.3 billion a year on tax credits, cash incentives, private school tax credits, and oil and gas tax preferences. Some of these programs have been criticized by the state's own watchdog. Others do not receive the same kind of return on investment review. So here is the $1.3 billion question. Who gets the money, and what do Oklahoma families get back? Here is the annual estimate. Investment and new jobs tax credits average about $733 million a year. Quality jobs and commerce cash incentives add about $100 million. Private school tax credits now reach $275 million a year. And the horizontal drilling tax preference costs about $173 million. Together, that is about $1.3 billion a year. Oklahoma has an Incentive Evaluation Commission. Its job is to review whether incentive programs are working. But the commission can recommend changes, scalebacks, or elimination. It cannot force lawmakers to act. And when lawmakers ignore the watchdog, the spending keeps going. This is not about saying the spending is illegal. The point is more basic. A program can be legal and still be a bad investment. If taxpayers are spending hundreds of millions of dollars, the public deserves to know whether those jobs would have been created anyway. The real test is household income. If these programs were creating broad prosperity, Oklahoma families would be catching up. But they are not. Oklahoma has lower median household income, slower income growth, and higher poverty than the national average. Oklahoma's strategy has too often focused on being cheap labor, cheap land, low taxes, and low operating costs. That can attract employers. But if the jobs do not raise household incomes, they do not change the future for Oklahoma families. And the problem is getting worse. Oklahoma's in-state college-going rate has fallen sharply. Fewer graduates are moving into the post-secondary pipeline that higher-wage employers need. Low taxes alone do not explain prosperity. Colorado's corporate income tax rate is slightly higher than Oklahoma's. Yet Colorado has much higher household income and a far more educated workforce. The difference is not just taxes. It is investment in people. Private school tax credits were sold as school choice, but about 92% were already in private schools. About $83 million went to families earning more than $201,000. And the money is heavily concentrated in Tulsa and Oklahoma counties. That means taxpayers across the state are helping subsidize private school tuition for higher-income families in metro areas. The Quality Jobs program pays cash incentives based on payroll, but applications for all but two of the largest recipients are shielded under non-disclosure agreements. That makes it harder for taxpayers to know whether billion-dollar companies really needed the incentive or whether the jobs would have happened anyway. Oklahoma also continues to subsidize horizontal drilling through the reduced 5% gross production tax rate for horizontal wells. The Oklahoma Tax Commission estimated this costs roughly $173 to $179 million in lost revenue. Horizontal drilling is no longer experimental. It is the industry standard. If proven technology is the reason to end support for wind, the same standard should apply to oil and gas. The real question is what Oklahoma gives up. $1 billion a year could strengthen schools, career tech, college affordability, child care, health care access, housing, rural hospitals, and workforce training. Those are not side issues. They are the foundation of a higher wage economy. That is the question Oklahoma taxpayers should be asking. Who gets the money? Who checks the return? And what do families get back? Business rankings mean little if Oklahoma cannot attract higher-value businesses that raise household incomes. Oklahoma does not need another press release about being business-friendly. Oklahoma needs an economy where working families actually get ahead, one that raises household incomes, strengthens the workforce, and invests in the people who create the state's future.